after the start of December, so again, right when these other data points are coming out that we just highlighted, we had a 10 to 12% drawdown over the 3 weeks into OPEX. Today's Friday, November 25th. It is the day after Thanksgiving, and we hope you all are getting some rest over this weekend because things are about to get a little volatile. Now, we want to be clear about something before we start this video. We do not have an edge here thinking that the market's going to go up or down into the end of December, but we do think that the movement, whichever direction it's going to be high, and that there is a really big risk to the downside here. On your screen, what you're looking at is the VIX 9-day. And what that is essentially looking at is the volatility, implied volatility level of S&P options that expire 9 days or less. Now, the normal VIX looks at 30 days or less options. So VIX 9-day has, a very short-term view on volatility. And what you can see on the screen here is obviously we are at year-to-date lows in this measurement, which suggests that there's not much fear of short-term downside. Now, we are heading into the end of November, which has been a pretty good month for markets. But as you can see on your chart right here, there are a couple of triggers coming up in the forms of data. And what is going to happen is that data is likely going to spark what we call a feedback loop into this very large December options expiration. So let's talk first about what these catalysts are. If you head over to Daily FX, they have a great economic calendar, and what you can see is that starting next week, really on the 30th of November, we have Powell speaking, we have GDP, followed the next day by core PCE, ICM, and then after that, we have non-farm payroll. So what this is going to do is really set up people's view of what's going to happen on 12/14 FOMC, right? That's the last FOMC of the year, and obviously the Fed and rates is really what everybody in the macro investing trading world is watching. And so all of this data is going to give a little more edge to people in terms of their view of what may happen on 12/14. Now, the risk is if the market does not digest all of the data points coming out of this week, we have a humongous expiration on the third Friday of December. That is December 16th. So let's look at this chart here. And what we're showing you is the delta notional by expiration. So essentially, if you were to look at the maximum hedge amount or the maximum value of options from a delta perspective by expiration, that's what you're looking at here. And calls are positive bars on this chart and puts are negative. And so what you can see as 12/16, we have a giant notional expiration for the S&P complex. This also includes the spiders and the Qs. So this is really the overall index complex here in the US. And before this, we don't really have any significant expirations. Now, what's going to happen with all of the data points that we've outlined here is they're going to trigger volatility. Now, people are either going to come out of this event and say, oh, look, Powell's now going to pivot. They're going to pause. They're going to take it easy. That can work the market higher, right? But the issue here is that if the volatility spikes, right, if we get a move off of these relative volatility lows, it's going to start to energize these put values. And these puts are likely not to get closed until OPEX, until expiration. And so what happens is as the market flies lower, dealers and market makers likely need to start selling futures. There's a demand for Vega, volatility spikes, and that feedback loop can't really snap until 12/14 Fed at the earliest, and likely doesn't really stop until OPEX. That's the 16th. So that could create this really negative spiral, this feedback loop that drives markets lower. And the analogy that we've been drawing out for people and saying, look, we cannot say that this is what is going to happen, right? But you need to understand the risks if traders don't like the environment or the data points that come out of next week. So given some bad sentiment out of these data points, this is more volatility than probably most people are expecting because of this December expiration. What we want to show you here is December of 2018. It was a pretty similar environment in terms of the macro uncertainty around rates, and just general capital flows. And so what you can actually see, it's interesting. The market peaked right at the same time. It's having an interim peak here after the start of December. So again, right when these other data points are coming out that we just highlighted, we had a 10 to 12% drawdown over the 3 weeks into OPEX. So there is an extra week here in this December timeframe based on how options expiration falls. But if you remember, there's a famous call where Mnuchin called around the banks to make sure they all had liquidity, and that occurred on Christmas Eve. OPEX in this case is a week earlier due to the way the calendar works out. So you can get a lot of volatility. This is the same situation. Huge December expiration put positions, right, are sitting out in the market. Those The values of those increase as the market drops. Volatility is spiking. All of that is a reflexive feedback loop that can drive market prices lower. And then, bam, we get expiration. All of those put options clear out, and we had one heck of a rally into the end of the year. And so this is one of the scenarios that we want to draw your attention to, because, again, if this data is a little bit weak next week, then we could really see that start off this feedback loop that fills into that December 14th through 16th timeframe. Now, if you have any questions on this, we track this every single day. We're updating positions every single day for our subscribers. All you have to do is head over to SpotGamma.com, hit start your free trial, and you get a free 7-day trial. And it will be a very interesting week to watch the options market next week.